How's it going? It's Steve, and I have another question and answer session for you today. And the question today is actually one that's pretty common. And the question is how do you actually determine as a lender what a person qualifies for as far as a loan amount and a purchase price? Well, that has a number of factors. Let me go over those factors for you. First thing we look at is we look at how much money you're putting down, and then we take that amount of money that you're putting down, and we actually look at what your income is and how much debt you have and what your monthly payments are in relationship to the income as related to your current monthly debts and your minimum payments on those debts that show up on the credit report. And then what we do is we actually look at we go backwards and we determine what you can qualify for based on what's called ratios. We have what's called a front-end ratio and a back-end ratio. A front-end ratio is a relationship between your what you make, your income, and your as related to your housing payment, what your housing payment could be. And your back-end ratio is a relationship between that housing payment, that specific payment, principal, interest, taxes, insurance, and your additional debt, such as your credit card bills, your car payment, whatever it may be that you have on a monthly basis that you're making payments to. So when we look at that, we actually take a percentage of that particular income that you have, and we go to a maximum amount. Well, that determines what you can actually purchase based on those factors. So we usually go at 35 over 43, and that's a common factor within FHA, VA, Freddie Mac, and Fannie Mae. And then sometimes you can push it up or push it down depending on the variables, credit score, and the times and what the lenders want to do, that kind of thing. But as a basis, that's the ratio that we usually look at when trying to get people qualified. Now, I have to tell you that I don't do mortgages anymore. I did them for 25 years, but obviously after 25 years, I know what I'm talking about. So as a lender, so basically as a lender, that's what they look for. And then they look at your credit history. They look how much money you're putting down. They look at your cash reserves, how much money you have available after you put your down payment and you paid your closing costs, or had somebody pay a portion of your closing costs or all of it. And then sometimes they will require a 1 or 2 months cash reserve requirements. That's money over and above. It's your money. It's sitting in the bank on your behalf, but it's just sitting there just in case as a protection. Okay. So that's what Freddie Mac, Fannie Mae, FHA, and VA do. And hopefully this has been helpful. If you'd like to work with me and would like me to help you buy a house or have you sell your home, you can be assured I know my mortgage side of the business. Therefore, I'm going to increase your probabilities of getting a qualified buyer who wants to buy the property. And we'll go from there. So my website is stevelinnin.com. That's STEVELINNIN.com. Go check it out. It's a portal. And go through all my different sites and get back with me and discuss if you'd like to work with me, and I'll send you out a pre-listing package, or I'll send you out some information regarding buying a property. And you can also obviously look at all my other videos. So have a great day. Look forward to talking to you in the future, and we'll go from there. Take care.